I'm the past chair of the Commercial Global Business Network of NICAR. For those who don't know, NICAR is the Northern Illinois Commercial Association of Realtors, is the NAR Commercial Overlay Board. Thank you everyone for your participation. I just like to call upon, I see Holly Becker. Holly, could you please unmute and just introduce yourself and see and tell the group who you are?
Hello, everybody. I am Holly Becker, and I am the manager of Global Alliances and Business Development at NAR. So I am very happy to be here today. I am just getting over having COVID, so I am participating and happy to be here today.
Thank you, Holly. So, Holly has been on the ball from day one since we got on. So just remember, you need to talk to somebody. This is one more person at NAR Global. Thank you, Holly.
Exactly. And feel free, anybody here, to contact me with anything, any of your questions with NAR Global anytime.
Yeah, Holly, just leave your contact.
I will.
Yeah, thank you.
Okay, thank you so much.
Thank you. And Andy, the NAR NICAR President Andy Welkme is on too. Andy, did you want to say something?
Sure. Can you hear me?
Yes, go ahead.
Yeah. Thanks, Ahmed. Thanks, Teresa. Thanks for organizing this. We're excited to have a robust group of participants and interested myself in hearing what the esteemed speakers have to say. As NICAR's Commercial Global Business Network, we love to really provide some value to both our members as well as our partner association members and others who are interested in, the intersection of commercial real estate and global real estate. So just looking forward to today's event. Thank you all.
Thank you, Andy. Teresa, it's all yours.
Thank you very much, Ahmed. So just a reminder, this session is being recorded. We do this every month, as I had mentioned in the beginning, if you logged on a little bit late. We're always welcome to new presenters from all over the world. So definitely feel free to contact me after the session to give feedback and talk about other possible topics or presenters that you may know. And just a reminder, as terms of format, it's webinar right now. So the presenters will have the microphone without interruption, but feel free to write your questions in the Q&A session. Generally, I hold them for the end unless it makes sense to interrupt for some reason. And then feel free to also include your contact information in the chat session, and you can download the chat session after everyone has submitted, so you have that for later on. You can also share your commercial needs and wants if you had something, for sale or lease or that made sense on a global scale that you thought, this audience could benefit from. So without further ado, I'm going to introduce the presenters, and we will move forward. So our first presenter is Raymond Wong. He is the Vice President of Data Operations for Atlas Group's Data Solution, and he has over 30 years of market research experience, overseeing 60 plus researchers across Canada. His primary responsibility is to ensure that commercial and residential data collection is all-encompassing, reliable, and accurate, and it adheres to the Atlas Group data governance guidelines. He works closely with internal and external clients to ensure that information meets their needs and that is both accurate and timely. He's also presenting on key market trends like he is going to today. So without further ado, Ray, the mic is yours.
Great. Thanks, Teresa. And I'm probably going to Are you seeing it or not?
Yes, great.
Okay, great. So we'll get right into the presentation. So the Canadian marketplace, similar to what was happening with the U.S., overall activity was a stellar year in 2021, and when we compare it to pre-pandemic, we're up by 45% based on the year-end numbers. But when we look at the year to date with 2022, we're already at 21.2 billion, and that was a result of a strong fourth quarter in Canada, largely driven by the office transactions we saw in the fourth quarter that closed in the early part of 2022. So it looks like we're off to a very stellar start for investment activity, and this is representative with the overall confidence in the capital market side. And this is despite the increase in interest rates to sort of tame inflation. So in Canada, we're slightly lower than the US. We're around 6.7% as of February, early March. And we're going to have the same challenges that based on increasing fuel prices and resources, and as well as that impact ripple effect to groceries and supply chain logistics, we're probably going to see further increases in prices. And despite with the rapid increase in interest rates, that I don't think we're going to see sort of hopefully we'll see a bit of a slowdown, but I think we're going to anticipate higher than normal inflation rates in north and south of the border going forward. And the question is how's that going to impact values and investment demand? So again, what we said compared to last year is that office, there's a bit of a gray area only because of whether or not people are coming back into the office and whether or not we've seen the end of scale back of space or sort of the right sizing of tenants. So whether or not the office activity continues as towards pace, I think it's going to drop a little bit, only because industrial apartment as well as land continues to make a strong portion of the overall activity. So far, again, we haven't really seen a drop off in investment activity with the new deals beginning of this year. But we may see, based on some of the rate sensitive amongst the private players, that we may see a bit of a slowdown. But right now, there's a strong demand for investment product across Canada. And this is our investment trend survey. So it's no big surprise that, especially on a foreign basis, buyers, the target is Toronto, Vancouver. And it's sort of is interesting. The further down you go on the bar chart, the higher yields that you see, especially with what's happening with Alberta. And Alberta is actually benefiting from north of $100 a barrel oil prices. So whether or not that continues remains to be seen. And this gives you a breakdown of what product is mostly in demand. And this is very probably similar to what you're seeing in the US, food anchor retail strip, followed by multifamily, industrial. And again, industrial is especially over the last 18 months, has seen the biggest increase in rental rates, especially when you compare it to office and on the retail perspective. And the overall pricing. So this is, again, I'm changing my tune almost on a weekly basis, and be interested to get Ted's comment on this as well. We think that based on the interest rate increases, that cap rates will move a little bit higher for sort of your B class and perhaps your tertiary markets. But your core assets, especially on the industrial front, will remain low, if not lower. And we're starting to see on a consistent basis, especially with Toronto and Vancouver, industrial cap rates drop below 3.5%. And usually that's reserved for the multifamily side. But that gives you an idea of the overall demand for that type of product. And part of this is that what we're seeing, and this is driven a little bit to the office side, is the work from home. And we've seen a big migration, interprovincial migration of people, especially with respect to British Columbia, the Atlantic provinces, Nova Scotia. And again, it's sort of that work-life balance and the flexible workplace where you don't have to be in the office. And the first time we've ever seen, there was actually more people moving from Ontario to Quebec than vice versa. So again, affordability and housing is going to be a key topic over the next couple of years. But again, it's been a key topic in Canada for the last 20 years. So when you look at overall pricing, again, people are moving where there's affordable housing, and especially when you look at the price points with Vancouver and Toronto. And saying that, the interior BC, which is recognized as a secondary market, places like Kelowna, and if people have vacation there, it's just a wonderful climate. But they've approached $1 million, so it's slightly lower than Vancouver, but again, bigger bang for your buck. And you look at the impact on apartment vacancy rates, they're falling, partly because of the increase in prices of housing, and is forcing people to rent rather than buy, just because affordability has sort of shifted over the last few months with the increase in interest rates. Again, all of this is impacting the office market, and we are starting to see an increase in Vancouver and Toronto with the number of people going back. But again, it's still not pre-pandemic levels, and we're still seeing an increase in the office availability rates as companies still try to figure out what their needs are based on whether or not people will come back to the office. And what we've seen in the last couple of months is that you can't really force people back. And based on the low unemployment rate that we have in Canada and the US, the challenge is that people can pick other jobs, and so you have to look at from a flexibility standpoint. So again, this is that push and pull at this point, that trying to get people back in. But again, it's nice to have that hybrid environment whereby you can be working at home and to pick up your kids to go shopping in mid-afternoon when it's less busy. It's hard to go back to the office sitting at our desk 9 to 5. So I think the whole office place setup is going to be changed going forward. And again, there's not enough data, but when you look at the mobility data that you're seeing in North America, there's an increased number of people downtown, but again, not to the pre-pandemic levels. When you talk about the industrial availability rates, just lower across Canada, driven by e-commerce, as well as sort of a demolition of some of the older product. So there's still a certain amount of tightness in the marketplace. And you look at the overall rental rates, this is similar on a global basis, with industrial rental rates continuing to push up based on the low availability rates and what's happening with respect to overall industrial land prices continuing to move up, almost changes on a weekly basis. But the concern that we have right now, in addition to the market fundamentals, is how materials and commodity prices have increased. It's no surprise with respect to lumber prices that we thought we saw the end of it last year, but again, we saw that large shoot up with lumber prices beginning of this year. It's starting to drop off, but still remains at high levels. And when companies are looking at pro forma, especially on the housing impact, it will start impacting housing supply and affordability, and we might see some cancellations especially on the apartment condominium side going forward. So the issue that we also have is, and we had this pre-pandemic with regards to retirement and recruitment, there's not enough labor. So in addition to increase in materials, we're also seeing an increase in labor prices that are also increasing the cost of the projects. So what's next? The market fundamentals for the most part will remain stable. Again, we still have long-term leases in the office space, and we won't see the impact of the office market until sort of probably next year, and see whether or not the seventh wave of this COVID, whether or not there's going to reverse back to the office policies. And again, we're watching the interest rates, we're watching the inflation rate, and it's almost that this new set of data comes out on almost on a weekly basis that impacts it. But you have to look at the medium and long-term impact, and there's going to be a lot of noise in the market in the short term, but we have to look at further out, and especially how people go back to the office, and as well as the impact of interest rates on inflation. So that's it on my side. Now, I guess I'll turn it over to Ted. Teresa, you're on mute.
Apologies. Thank you very much, Raymond. And I certainly have a few questions, but I'm going to wait until after Ted presents because he might answer some of my questions. So up next is Ted Davis. He's the managing director for Avison Young Toronto West and Southwestern Ontario. He oversees daily operations in a region that's experiencing major growth and movement, specializing in the sale and lease of properties for sectors such as warehouse, manufacturing, office, tech, and life sciences. For 20 years, Ted has been involved in over 1,000 transactions totaling more than 1.5 billion in industrial development, office, and investment properties. So he could really take a global view of commercial real estate and add to what Raymond had just talked about. So without further ado, you have the microphone, Ted.
That's great. Thanks, Teresa. Good morning, everybody. Let me share my screen here so everybody can see it. So I appreciated the data points that Raymond was able to provide. Raymond and I work a lot together, and his job is to figure out what the variables are that are affecting the market, and my job is to figure out what that means on the street. So what I want to do is, before we get into further questions, and again, to Teresa's point, please feel free to put them in the chat and we can answer them afterwards. But before we get into discussions about interest rate changes and how that affects everything, what I wanted to focus on today was looking at some of the other, call it non-statistical data that's affecting real estate today. And so what we're going to look at is the effects and the variables where ESG, so environmental impact, is having on these properties. And that's driven by generational changes, as well as almost reevaluating what properties are today and what they can become. So I'll start to go through here. Teresa touched on my background a little bit. So again, a lot of this information and the questions that I can certainly answer come from more of a macro level view, managing brokers, project managers, property managers, and I'm happy to address those. So one of the significant changes that we expect to see and are seeing for everybody who's involved either on the brokerage or the investment ownership side, as well as the occupier services, is the effect of our goal of getting to a zero carbon world, and the impact that not only does that have on employees and labor and supply, but as well as the operation of buildings, what those returns are and what the investment that's required into them. So I'll provide the link at the end of this. There's online, everybody has access to it, that we look at each of these individual points in more of a micro level. What I'm going to do is just run through on a more macro level, talk about what some of the major variables are, and those major points that we're talking to a lot of clients about on a daily basis. So I think the big thing to look at is that a third of the global Fortune 500 list, they've publicly pledged to try to achieve net zero carbon. What this means, I mean, this is what sometimes some people perceive as a bit of a just more of a media coverage and just a saying, but the impact of that is unbelievably significant. And that has to do with really the term social investing. And so you're no longer just investing into a financial return, but you're looking at investing to provide a social return. And so that includes climate change, that includes how your employees are treated, how they feel when they're coming into the office, the general structure of the business, and to still operate instead of just having one minute view of what success means, is having more of an expanded view and looking at what makes a successful company. One point is a stock price, but what are the other variables that play into that? So it's the environmental impact, and that comes from where you're getting supplies, the buildings that you're in. How do you do that more efficiently? What effect does that have? And that's really what we're looking at here. So the interesting part about this, when looking at the entire makeup of a company and where the impact of the environmental and carbon footprint really come into play, is the interesting statistic that we have up here is that buildings are responsible for 38% of all emissions and 35% of global energy consumption. That in reality is an unbelievable number. I mean, over a third of the impact is coming from buildings. So obviously, it's one of the first things that people start to look at when making decisions as to where to invest their time and resources. So what we have here is really looking at what are the different options. And again, where the relevance of this comes in is for those brokers that are in the audience right now, it's the decision making that comes into play when deciding on whether to stay at a property, whether to lease another property, whether they take smaller footprints but in more locations, or the opposite, pushing remote work, etc. It's interesting over, I would say, the last 12 months, where when I'm sitting at a boardroom table or I'm presenting to a board of directors, the people who are there, who are the decision makers, so the CEO, the CFO looking at the financials, probably an operations person. The interesting thing to me is, especially with the large corporate clients, as well as the private ones, is there's usually somebody who's involved with the ESG modeling is sitting at that table as well when we're evaluating those buildings. That's a very, very interesting component when that additional voice is at that table and you're going through slides. And it's the same thing if I'm a building owner, I'm making those same distinctions and I'm thinking about that when I'm out there in the market. Now, the question is really going to come down to, and we'll talk about this in a little bit, is there a defined ROI? So for a building owner, if I'm going to invest money to, as an example, try to be LEED certified, what does that mean? Does that change what the net income or what the lease rate is going to be for a tenant who's coming in because they can hit those certain points? As well, the other component that becomes significant is, how does government regulation really tie in with this? Because if I'm doing new developments, that's going to become either an opportunity or it's going to be a hurdle that I need to try to figure out as to where I'm going to invest money. So when looking at, and this is a presentation, a slide, sorry, that I've used a number of times when talking to different clients, is looking at what the different options are when trying to evaluate from an ESG standpoint as to what their next step is. So you can see the funnel that's there. And again, all of this will be available online with the link. So, and I'll put that in the chat as well. But really the ones that I wanted to focus on is, obviously there's the opportunity of build nothing. So that's the first thing that comes into mind, where previously where you would see people say, you know what, let's take industrial as an example. 18-foot clear heights. The building is becoming pretty tough to do. I could expand it here, but realistically, in my ideal situation, I'd love to go out and build whatever that dream building ends up becoming. People are really starting to rethink that. And that isn't necessarily driven by financial modeling. That's driven by ESG modeling. And I think we're going to see this more and more. So it's looking at what the environmental impact of taking green space is, and then getting the supplies, working with labor, to Raymond's point, especially right now, almost more important because of the increased costs that are out there, and figuring out truly how to repurpose or refurbish buildings. I mean, we have everybody hears the saying that reduce, reuse, recycle, and you're supposed to do it in that order. So how do I reduce my footprint? How do I reuse what I already have? And then I will look at recycling. So it's very similar, the mentality, when looking at what to do with properties. The other one that I wanted to look at here is the build clever and build efficient. So those ones are becoming, you'll see this more and more, it's already out there. Those are industries in themselves. It really is unbelievable. Some of the largest equity increases with regards to new businesses is coming from the ESG and environmental sector. So that build clever, build efficiently, when you do some research and really dig into it, I'm not going to go too deep into it on this just from a timing standpoint, but it's unbelievable the innovation that's out there right now that people are applying to properties. So the reuse of materials, the low carbon materials and products, one in particular that there's been, I think there was an announcement last week with regards to some VCs and some very, very large institutional investors are really focusing on low carbon concrete and being able to manufacture that in a more productive manner. That company who's doing that, it's one of many, but this was just an announcement that was done recently, there's significant investment into that, and the people who are investing into it are inevitably going to be the people who are using those products. And they're doing that, again, because of the impact to the environment, but also from a financial standpoint in anticipation that that is going to become part of the presentation to tenants when occupiers are deciding on what building that they do want to go to. The other one is the building efficiently. My personal opinion with that is that a lot of that will end up being driven by technology. So very similar to where we're seeing low carbon materials and different products and the reuse of materials, is people are investing just as much, if not more money, into the technology within buildings. So for some people who have heard it before, prop tech or property technologies, another significant impact to our business. So if there's any takeaway from this conversation, I would certainly say to know and understand the new innovations that are coming through our market, our industries. That's going to make a considerable impact both to your client's bottom line as well as to the environment. So as you can see on the screen here, if the current growth trajectory in sustainable finance continues, and as I mentioned, I certainly anticipate that it will, it'll have major implications for the real estate development. So what I'm interested in looking at on this page is what countries are doing the investing, but in addition to that, what regulatory demands is that coming from? So is this driven by the private sector, or is this driven by government regulation? And anytime that we've seen significant shifts within an industry, whether it's innovation, whether it is changes in a trajectory, financial setup, the interesting part is that balance between the government regulation and in the private side driven by the financial markets. So I'll give you a really quick example, not necessarily specific to buildings, but when we look at electric cars. So for a lot of states and in Canada, a lot of provinces, they had put in incentives to invest and purchase a electric car. Slowly, those are all disappearing because now they have helped kind of build the requirements and the market for the electric cars. So now government can start to back out of it, and the private sector can start financially justifying the investment into it without those subsidies in place. We're already seeing very similar in buildings, and we'll continue to do so. I think that we're going to continue to see some significant regulatory demands that are put forward by different countries and different continents, but inevitably with the goal of there's a certain level of expectation that clients will end up having that will therefore be driven by the private sector, and private owners, landlords, etc., will then have to work with those tenants in order to get that without the government subsidies in place. And that then brings us to the dollars and cents of it all. So if I'm an owner and I need to invest money into my building, and for anybody who's involved in that process, whether it be from the brokerage standpoint, whether you're going to be listing a new property, whether you're an owner of a building, whether you're investing into a property, you're looking at what the capital expenditures are. So before I started, as Teresa mentioned, I started in the business about 20 years ago. I started with a gentleman who Raymond knows, who's been in the business. He was in the business since the early 80s. And he said the way that a deal gets killed is whether or not the roof is in good shape. That was how the deals, 30 years ago, that's how you lost a deal. When I came into the business, it was environmental. If it was a dirty environmental, my deal was dead. And that was the one that would end up killing my deal. So when investors would go into these properties, that was what they were analyzing. They were looking at, where am I going to invest my money? What are the attributes of this building? And how am I going to be able to get an ROI on this? We're going to see, in my opinion, we're already seeing it a little bit, but what we're going to continue to see is how the ESG and environmental impact is going to end up affecting the value of those assets. So as you can see, the little note that I put there is the benefits to asset owners are compounded because occupiers are not only prepared to pay more for a more efficient building, they're also prepared to commit to it for longer. Part of the reason that wanted to bring a little bit of insight into the longer term of the leases is because majority of buildings don't have that level of environmental obligation that other buildings do. The other part of it is that they do take a significant investment. And so because of that, it's like putting in, if you have a high-tech manufacturing building, or if you have a data room within your office and a backup generator, to then go and move that becomes that much more difficult. This is very similar. So not only, especially more so as we continue to move forward and government regulation comes into play, in my opinion, not only will it start to increase rent, but tenants will lock in for longer terms because they don't want to go through the process of moving. Again, if one of your major goals is social investing, shutting everything down, moving and rebuilding it somewhere else is not overly efficient, and that in turn affects your carbon neutrality. So those are all going to be variables that can be used by owners and brokers in the future when talking and making decisions with corporations as to where they're going to set up. The other thing that's really driving this is the change, I believe, within the office space. And one of the interesting points that a lot of people talk about is the fact that this is almost one of the first times in history that we have essentially 5 generations sitting in the same office. So what that means to the Gen X, Gen Y, Gen Z as to what they want to see out of a workplace versus, let's say, a millennial or a baby boomer may be different. So trying to work with those groups and trying to provide everybody what they want. And again, the interesting part about managing a lot of people is I find that financial for employees is a variable, but not the biggest one. If you start to survey people and ask them what it means to them when making a decision as to where to work, especially in this environment, it's not necessarily money that is that driving factor as to what they are making that decision over. So this is also going to become not just a decision for occupiers, large Fortune 500s, large private companies, not only from an optic standpoint when presenting to their shareholders and investors, but also it's going to have an effect as to decisions that they make in how environmental plays into that, leases that they sign, new buildings that they build, but also with their hiring and their labor force. How do they attract people? How do they get employees? Culture is definitely one of them. My opinion is the environmental impact and the social investing that a company does is directly in line with what the culture is for that company. So finally, when looking at the investment that's done and how to do things differently, the most exciting thing that I see about our industry today is the technology that's being put into it. And I'm not going to dig too deep into this, but it is truly unbelievable as to what our industry is going through. Traditionally, commercial real estate has been a little bit slower in adopting different technologies over the decades, but really no different than any other industry, automotive with Uber, retail with Amazon. There is a transition, I believe, within commercial real estate in general. And so with that transition becomes significant, as I mentioned, innovation and technology. And that is where we're going to see a lot of investment from companies. And tying back in with Raymond's presentation, that specifically is when we're looking at lease rates and where they are today. If my occupancy costs are doubling or tripling in some cases, well, now all of a sudden the investment to make into those properties is a lot easier. Let's say I didn't want to have smart building designs or warehouse optimization because the platform would cost me $20 million. Well, if my potential occupancy costs have increased by 20 million a year, that's a pretty quick ROI. It's no different than how when government subsidies were in place and people were being pushed to replace their lighting, and you take out the old halogen and put in LEDs. There was a simple ROI that went along with that. This is no different with technology overall, and will also be in demand from a social investing standpoint. As you can see, the link is here at the top. I will copy and paste that and put it into the chat. And Teresa, I will hand it back to you.
Thank you very much, Ted. That was super amazing. Both super great presentations, and environmental is near and dear to my heart. My master's was in environmental engineering at U of I. So always love seeing technology advancing in that realm. So I have tons of questions. If anyone else has questions, please put them in the Q&A session and I'll be sure to ask them. My first question is for Raymond. You were talking a lot about, that pull back to office space or whatever, but in Canada, are you also experiencing labor shortage, especially in the service sector? What's causing that? What are the solutions? Because that's something that we're experiencing here in America. We want to launch these businesses. We have all this commercial real estate that's being ready to be occupied, but we don't have enough people to employ. So what are you experiencing in Canada? Exactly
the same thing with US that we had about 420,000 people with result immigration last year, but prior to that it was at a much lower level. And with increase in tech opportunities, especially in Vancouver and Toronto and Ottawa, that is really driven up wages. So again, we had an increase in employment as of last Friday based on Statistics Canada, and there continues to be a shortage of people, and as well as increase in wages. Even the summer student program, that we were trying to get a couple of summer students in Vancouver, and they're asking like $50 to $60 an hour, and or just you're just shaking your head. Can I sign up? And we didn't hire that person, but it's amazing what they think that they can ask for. So it's a bit of a ripple effect with respect to trying to find people. And what we're also finding is that because we're at the ULI meetings a couple of weeks ago in San Diego, and the discussion there was that there was also a movement back north of the border of Canadians, especially on the tech side, right? So we see that bit of a drain in the US, but we're still going to see continued issues. And what Ted and I spoke earlier about, especially with the construction sector and trades, and it's just going to keep pushing prices up. Like in Ontario in the past week, there's over 16,000 construction trades on strike, right? Mm-hmm. And I think that there's the limitation of 60 days that they can be on strike before they're being forced back. But again, all that impacts the costs and as well as pushes the inflation. So we're experiencing the same issues. And again, until we get that immigration flow through, there's going to be continued challenges with wages and keeping people or retaining people at work. Thank you very much, Raymond. My next question for you, Ted, is where you're seeing very good examples of being socially sustainable building, like what countries are really doing a great job of exemplifying this, or what projects?
Yeah, so I would certainly say that, we are seeing some investment for sure in US as well as Canada. The government in Canada is putting a little bit more subsidy as well as pressure on it. I've been seeing in Europe, there's been a lot of government regulation, not necessarily subsidizing, but regulation that's being put on properties, especially for new builds. So that's really, if you look at the adoption of these types of innovations in the past, it's almost generational from a standpoint of you see it really come to fruition 15 or 20 years down the road, maybe 10 years down the road, because it's starting with And we're all going to end up seeing it in the near future, because a lot of these laws are in place right now or being worked on. Is you'll go into site plan approval, and either the local municipality or the overseeing body will inevitably, this will become a point of discussion. So now those buildings, those new builds, the new industrial parks that we start to see online or coming online, let's say there's a flow through of the next 5 to 7 years with new construction. Those are the buildings that we're going to start to see a lot of these innovations, focusing on ESG. That's where we're going to start to see those. I think the other spot that we are going to see them as well is in downtown cores, working with occupiers to try to attract people into the offices. Is we're going to see build out and investment into those buildings, and ESG will be a variable in that, because part of it is, and especially for developers as well, if regulations start to come in and they can promote and talk about carbon neutrality in their development, well, there needs to be significant investment to try to offset that. So carbon credits, working through and figuring out where to invest the money. So again, I would say Europe and North America, significant investment, but inevitably we are going to see it everywhere with a lot of retrofits and new developments in the future.
And for both of you, we talk about technology advancements, but can the development of technology and adoption of technology keep up with climate change? Because that's obviously progressing at a very quick rate. Can we keep up?
And that is, if you read all of the information on the Paris climate change, on the UN and the work they've done, that right now for us is the $1 million question for everybody as to whether or not technology and adoption will keep up with the inevitable environmental demands.
Mm-hmm.
Yeah, and just to add to Ted's comments, and the challenge is whether or not it's superficial change or actual change. I think we have the E down pat with regards to dealing with green buildings, but it's the social governance that holding people accountable that I think will be challenged, and it's a mindset of change of how we deal with personnel and the different diversity within the organizations. And again, as Ted mentioned, it's not just your organization, but it's your suppliers and holding them accountable is with respect to your buildings and to your contractors and so on and so forth. So, and I totally agree with Ted. That's the question that this is mentioned in every single conference, but the action is will be interesting to see the next 12 to 18 months and see whether or not this actually makes a difference to overall costs. And technology is one of those elements. And again, it's we've had that technology for a long time, but now it's slowly being implemented because we're sort of being forced just because of the labor challenges. But it's going to be a big question going forward.
One of the interesting things, Teresa, is just a bit of an anecdote for everybody is, so there is the province of Ontario has a specific act that they put in place trying to spread out employment. So in other words, instead of just focusing on the Toronto area, they're looking at tertiary markets. So you saw some of the cities on one of Raymond's slides, Kitchener, Waterloo area, and some locations getting down closer to the Buffalo and Detroit border in smaller towns in Ontario. So what's starting to happen now, and what we're starting to see, is there's government bodies that are moving their head offices out of the downtown core of Toronto and moving them more into those tertiary markets. And we're seeing that all over the place. That driving force being kicked off by government to say, okay, we're going to move our 60,000 square foot office and put it somewhere else. That I could see being the same driver as well in the marketplace when Ottawa is a core for us, Vancouver, Montreal, Toronto. When we start to see those government leases and the demand that there's specific requirements that can take your building off the list for a government lease because it doesn't have certain environmental applications in it, that's what's going to drive that investment, because you don't want to lose out on those long-term leases and you don't want to lose out on the covenant and the rates that come along with that.
Mm-hmm. Ahmed, you had a question? Unmute yourself, Ahmed.
Sorry, I had a question for both. So Ray, do you have any data on foreign investment in Canada?
Yeah, we do on the commercial side. And The last couple of years, it's been a little bit muted. But again, the Royal Bank Plaza, which sold for over $1 billion and closed earlier this year, was bought by a foreign player. And there's definitely interest in regards to investor activity, but it's been also we're also seeing private investors sort of step up. So we're definitely going to see an increase this year. But Canada is getting very well known, especially with Toronto, Vancouver. Ted can speak a little bit more with regards to the investment activity.
Yeah, thank you, Ray. And Ted, in terms of now government has regulation, but what about the collaboration between the government, private sector, and academia? And in Canada, I think that's being kind of set up. Can you talk a little about that, please?
Yeah, absolutely. So you're absolutely correct. I mean, that becomes a major component, and we see a lot of what we call public-private partnerships, which is the same thing that we see in the U.S. marketplace as well. So there's, again, that almost comes down to the subsidizing or fast tracking certain applications and innovative applications. I mean, there's a number of different sectors within the government right now that they've set up specific departments so that when you're going in for approval, it isn't a long-term approval because of how quickly tech and innovation is moving right now. They have specific departments to deal with that. And so that helps bring products to market quicker. And as well as there is an incentive that's there, government subsidies to assist with that. A lot of pilot programs as well. We're seeing those three groups as significant partners. From a corporate standpoint, inevitably they're doing it almost as a tester for future adoption. For the academic, they can put their names on the technology, be involved with it, test it, and run those relevant variables through the process, and the government overseeing it. But we truly are seeing much more collaboration, where in the past you would almost wait for the brick wall when you start to go in for approvals. It's quite the opposite in a lot of cases right now when it comes to innovation.
And a follow-up, Ted. Mm-hmm. So how do you educate that smaller investor? Well, if your client, does not have the resources of the larger entity, how do you present this to them?
Yeah, so
it's a whole day webinar, but just in a short.
Yeah, agreed. So on a very, very high level, the most interesting thing that I've seen is when you look at the historical timeline of technology, inevitably things become smaller and cheaper, right? When the first cell phone that came out, I mean, for those that remember first microwave or first VCR, when you were spending $2,000 to buy a VCR and it was, pretty much the size of a car to watch a video. Then it all of a sudden you could buy it at Walmart or Target or wherever, and it was on sale for $50, and it was much smaller and easy to carry around. Technology for buildings is becoming the same way. So in other words, what we're starting to see right now is, like for me, let's look at focusing on one particular piece, is smart monitoring of buildings. Well, before that was a significant investment. That was something that if you wanted to see who's coming in and out of the buildings, what is the, what's the heat use that is being used, or the HVAC use that's being used, is the roof and the material that's being used on a daily basis, the fuel consumption or the electricity consumption. That was a huge investment. Well, now when you look at it, I mean, look at Nest, which is in a lot of our homes. I mean, we have smart Internet of Things monitoring in our homes. So the ability to take that technology and apply it to smaller projects with smaller landlords, both financially and size-wise, is absolutely there today. Won't have the same level of impact, agreed, but it absolutely comes down to, if everybody does their part, there will be benefit. And when presenting to tenants, that becomes a very good story to tell when it shows that monitoring systems are being put on each of our buildings. We're putting in check meters to be able to track water and electricity consumption. All those smaller things, which really don't cost a lot of money, can still have significant impact, both environmentally, but as well as optically when trying to attract that tenant.
Thank you, Ted.
So we have a few more minutes, and I do have a couple more questions, but for both of you, what are we not asking? When you go to all these different presentations, what's something that is super insightful that, you feel like everyone should know?
I'd like to ask a question to Raymond, if I could, on that same note.
Ted, you're
Here's
not
what my-
allowed.
Here's my big question, Raymond, and I'm putting you on the spot since we have an audience. Based on your slides, we're seeing significant increases, obviously, with cap rate decompression, values go up significantly, lease rates go up significantly. Those inevitably are going to be provided through to, for us, the Municipal Property Assessment Corporation, which is what our taxes are based on. How do you anticipate these increased costs affecting the occupancy costs for tenants through potential tax increases? In theory, if you have doubling the value of a property, you're going to have doubling the value of the taxes, and that could mean a big difference for tenants.
Yeah, and the timing on that question is amazing. I presented yesterday to the Canadian Property Tax Association, and we talked about the increase in values, but we also premised it with the impact of inflation and perhaps the slightly inflated residential sector, just because of the pent-up demand and the low interest rates driving that up, right? And everyone knows, I think, hopefully, that by driving sort of those values up and having that impact, and especially with overall costs increasing, it's going to make a concern, but it's going to happen. But the increases we've seen, especially with real estate values, commercial and residential, and you look at industrial, again, a sub 4% cap rates, it's going to have an impact on taxes, but hopefully it'll be a little bit muted. And especially with when you look at some of the municipalities, they're actually increasing development charges, which may slow down development, but they need to be able to support the development and as well as support their tax base. But again, that's going to sort of stop or slow down some of that construction, and as well as the property tax going forward. So I'm a little bit concerned in that area with some of the price points that we've seen over the last 4 years, but everything's pointing continued increases. But hopefully, it's also noticed that that this is not good with respect to pricing that increased costs are moving towards, and the potential impact to consumers, and whether or not that's going to actually push us into a recession, which is on top of mind with everyone right now, especially the whole idea about stagflation.
Okay, so here are my two last questions. First one for Raymond is, what is the biggest risk that we need to be concerned about? And for Ted, both of you are giving a very global macro view. From a micro, and this being an everyday audience, what is the number one thing people could do to reduce carbon footprint? Because we're not all, owning buildings and whatever. Is it veganism? Is it reducing? Is it using less energy? So if Raymond, you can go ahead and tell us, what is the biggest risk we're facing?
What keeps me up at night is inflation, because it's something that you can't really control just because of what's happening on a global basis, right? And even though wage inflation is moving up just because of the shortage of workers, it's not sustainable. And one of the banks released yesterday that they're going to give everyone a certain title, or that they're going to increase wages by about 3% for everyone, right? So there are companies that look at retention and attraction of employees, but that it'd be interesting to see over the next 6 months, and especially with where interest rates are moving, whether or not we go into a recession. And right now there's about 50-50 on that, whether or not we actually go into that direction. So that's the major sort of what keeps me up at night.
Mm-hmm.
I'll tag on to that a little bit, and then I'll jump into your other question, Teresa. So I'm in agreement with Raymond, but on that same token, I would argue that we're very much obviously in an unhealthy market right now. So to dip into a recession, though extreme, it still is probably a little bit of the shocker that the economy probably needs to see a little bit to level back off. And for the people who are on this call, again, assuming that a lot of them are brokers, as an example, is what everybody needs right now is product. And that's the hardest part. And whether a market is moving up or a market is moving down, there's transactions. So from a brokerage standpoint, that wouldn't, though I am in agreement with Raymond that from an overall global impact, it would be significant. Bringing it back to your question as to what the micro effects of that are, business will still be done. The interesting part of, let's take a 2008 as an example, 2009, the difference there is our vacancies were probably in some cases 4 or 5 times, if not higher. I think GTA was probably sitting somewhere between 4.5% and 5.5% industrial vacancy rates when we went into 08, 09. This time around, if we were to look at a recession, we're sitting at less than 1% vacancy. I mean, even if we doubled, triple, quadruple, we're still back to where we were and had been for the previous 20 years. So I think it creates some additional product if I'm looking at it from a micro standpoint. Going back to your other question as to what we can do is somewhat similar to my my answer with Ahmed, is that no matter what size, I think that where people, I think with anything that we do and we try to do better is we say, well, what kind of impact can I have? I'm just smaller person. It's not going to really make that much of a difference whether I get plastic bags from the grocery store, whether I eat more fruits and vegetables than meat, whether I, make any small impact that I do, whether I decide to ride my bike instead of taking the car today. What impact is that really making? To me, if everybody does that, then obviously it's done on volume and simple economics of scale. It's going to make a significant impact. To me, it's very similar to when comparing it to, our information that's out there, whether it's going to Google or Facebook or whoever it's going to. Our information, our personal information is significant and it's valuable. And when it comes to environmental as well, it's a very similar situation in that as consumers, we have a significant impact. I mean, we can see that especially through COVID and, you watch different Netflix documentaries or whatever else, the impact of the opinion of the consumer can have such a drastic impact on that company that we can really make huge change. And so I think being cognizant and conscious of what you are buying and where that product is coming from or how it's manufactured or how it's packaged and making decisions based on that, i.e. going to the farmer's market on a Saturday morning and trying to buy local and trying to buy that way versus going to the grocery store in some cases, that will inevitably make a significant difference. And that will push the large corporations as well to say, okay, this is what the consumer wants, and this is also what our employees want. We're going to start to make those changes.
Being very conscientious.
That's right. There's an underlying financial there as well. So it kind of, again, social investing. That's what it's all about right now.
Well, thank you very much, Raymond and Ted. This has been the most amazing presentation, and thank you for answering the questions. This will be a recorded session, so it will be available later, as well as the slides if anyone wants them. And I encourage everyone to put their contact information into the chat so that you can download it for after. I also hope that everyone will come to our next month's presentation, where we're going to be diving into topics in investing in Japan. And we're always welcoming new presenters from all over the world, so we can talk about whatever the hot commercial real estate topics are, as well as highlighting that country and opportunities within that country. So thank you again, both to our presenters, Ahmed, and everyone else who participated in today's session. We will end the recording and have a networking session in where you can introduce yourself as well as provide a commercial need or want. And thank you very much again. So we are ending the recording now.